What's up guys, and welcome to Wall Street Millennial. On this channel, we cover everything related to stocks and investing, and on this video, we're going to go over one of the most profitable trades in investing history. When you think about the greatest trades of all time, you usually think of hedge funds making complicated investments and perfectly timing the market. For example, Bill Ackman turned $27 million into $2.6 billion at the beginning of the pandemic by buying credit default swaps and benefiting from the market meltdown in March. Or the big short investor Michael Burry, who bought credit default swaps on mortgage-backed securities to benefit from the spike in foreclosure rates during the Great Recession. But in this video, we are covering the 100x investment return not generated by a hedge fund, but instead by an individual investor. And the trade was not made in the stock or credit markets, but surprisingly in the cattle futures market. The trader in question is none other than 31-year-old Hillary Clinton. In 1978, Hillary Clinton was a faculty member of the University of Arkansas Law School and recently married Bill Clinton, an up-and-coming politician in Arkansas state politics. Bill Clinton had recently been elected to Attorney General of the state, and many already viewed him as a favorite to be the next governor. At the time, the couple's combined income from Bill's Attorney General salary and Hillary's law school job amounted to a relatively modest $51,000 a year. Hillary wanted to increase their financial position as they eventually wanted to have a kid. She decided the best way to do this was to take on trading as a side hobby. She knew nothing about trading or financial markets at the time, so sought advice from a family friend, James Blair, who was also a lawyer working for Tyson Foods. Tyson Foods was a very powerful company at the time and was the single largest employer in the state of Arkansas. Blair told Hillary that he was having tremendous success trading cattle futures on the Refco Cattle Exchange. While cattle futures are usually bought and sold by cattle farmers who are trying to hedge the value of their livestock, they can also be traded by speculators who are trying to make profits off of price swings. In October of 1978, when Bill Clinton was on the verge of winning the Arkansas gubernatorial election, Hillary opened up a cattle trading account with Refco and gave control to William Blair, who executed most of the trades for her. She initially put in just $1,000 as an initial investment and aggressively used margin to scale up the size of her trades. William Blair traded the account for her and made winning trade after winning trade, ultimately leading to a 100-fold increase in her account value to $100,000 by the time she cashed out in July of 1979. Pretty good for a one-year return on investment. After bagging this 100x gain, she completely shifted her investment strategy and put the money into US Treasury bonds, saying that she, quote, lost the nerve for gambling. After Bill Clinton was elected president and Hillary Clinton became First Lady, their personal finances came under much greater scrutiny. In 1994, the New York Times published a report reviewing Hillary's financial records and uncovered the $100,000 profit that she made back in 1979. The controversy was exacerbated by apparently contradictory explanations from Clinton herself. She initially told her aides that she traded the futures herself and was able to obtain such profits through her financial acumen and detailed research of the cattle market. This explanation was not terribly believable because she had no experience either as a cattle farmer or a trader of any security at the time. She later admitted that she was advised by Tyson Foods lawyer William Blair, who executed many of the trades for her. The help from Blair was controversial because he worked for Tyson Foods and Bill Clinton was about to be elected governor at the time. Tyson was one of the nation's largest beef companies. Insiders such as Blair could potentially be privy to non-public information that could help him make profits trading cattle futures. Furthermore, Tyson Foods could have wanted to curry favor with the soon-to-be elected Governor Clinton, so he would shape policy in a way that is favorable to their business. After making such incredible investment returns, a natural question that comes up is how likely would the trading profits have been if they were completely legitimately made? Many people were interested in knowing the answer to that question, and several publications analyzed the trading results to find out just that. It turns out that her trading consisted of many short bets, betting on a crash in cattle prices. At the same time, cattle prices were in a strong uptrend. On October 11, 1978, she first opened up her brokerage account. Only a few days later, White House records indicate that she made more than 500% of gains off the $1,000 investment. There is even some evidence to suggest that the trades that made these gains were placed before her initial investment deposit was even completed. Only 10 days afterwards, she made $7,850 on another trade, and 7 days after that, another $7,200. According to Mark Powers, the editor of the Journal of Futures Markets, she only made these gains by taking extraordinary risks. On the one side, an unfavorable move in the cattle futures could have wiped out her entire family's net worth, while on the other side, there was a small probability of a windfall. Mark Powers said that the amount of risk that she took on so quickly after starting her trading activities was like someone buying ice skates one day and then entering the Olympics the very next. When it comes to the results of this risky bet, her $1,000 investment immediately grew by $5,000 in the first week, and within 9 months, her cattle futures trading had netted her almost $100,000 of profits, which is equivalent to more than $300,000 today, adjusting for inflation. According to an analysis published in the Journal of Economics and Finance, in which tests on real cattle futures data are constructed to, quote, give the investor the benefit of the doubt whenever doubt exists, the most conservative finding is that the probability of having a 100-bagger, like Hillary Clinton made, is about 1 in 31 trillion. 60 Minutes did an investigation into the probability of doing as well as Hillary Clinton did, in which they interviewed the chairman of the Chicago Mercantile Exchange, the biggest commodities futures exchange in the world, as well as market participants. One of those market participants was this cattle farmer and cattle futures trader, who had this to say about the likelihood of 100x returns.
Is it possible for someone who's a total novice, the way she was, an amateur, to jump in like that and in a few months make 100 times the money they invested?
Well, it's possible. It's highly improbable.
Even in that market?
Even in that market.
How did you do in that market?
Not as well.
Close?
No, we didn't do as well.
The chairman of the CME also stated that the trading history of Hillary Clinton during her cattle trading time was incredibly good.
In the 70s, here is 78, right here.
Oh, this is when she was trading.
When she was
78.
in. See what happened to the market?
Wow. And she was in it for this.
I think she got, well, I don't have the records.
I'll tell
right
you
now,
when
so.
she was in it. She was in it for this spike and got out right as it came down and made money because she bet it was going to go down.
Very good trade.
Finally, 60 Minutes interviewed a professional cattle trader who runs a futures trading fund. He expressed skepticism that she was able to take on so much leverage and make such extraordinary returns as a novice.
It's very difficult for me to believe that Mrs. Clinton was trading her own account and managing her own account. It's extremely difficult for me to believe that. Everything, it just doesn't make sense.
Markovitz has examined Mrs. Clinton's records that were released by the White House. In her very first transaction on October 11, 1978, she deposited $1,000, a small amount to start with even in those days, and made a $5,300 profit the very next day.
To do it with $1,000 is extraordinarily unusual. That's someone who made 500% on their money in one day.
To do that well her first day, Mrs. Clinton had to make multiple trades involving hundreds of cattle. But she was young and a complete novice without much of a nest egg. Markovitz says her broker was allowing her to risk losses she couldn't repay.
If someone told me that a person opened an account with $1,000 and the next day traded 20 contracts of cattle, I would say, well, someone's doing them a favor, someone to allow them to trade that way.
Trading futures involves extreme amounts of leverage, which means huge risks to the trader, but also to the exchange and brokers if their trader is unable to pay back losses on their trades. Because of this, margin calls exist, and there are systems in place to make sure that rogue traders don't rack up losses and stick them to the exchanges or their brokers.
Let's say I open an account with you. You're a trader, and I give you a couple of $1,000, but then I'm losing money. And you'll come to me and ask me for more money.
Absolutely.
Immediately?
Immediately.
And that's called margin requirement, right?
Right.
Would you ever not call in money from someone? A favorite customer?
You're obligated to do that.
You're obligated
To do that. To send out a margin call.
But Mrs. Clinton's monthly statements indicate that even when she was losing, she was never required to come up with more cash.
So how was Hillary Clinton, a novice investor with only $1,000 of initial capital, allowed to trade on a margin account so aggressively? Some people think that this would not have been possible if everything had been happening by the book. Her extraordinary risks taken and her extraordinary returns in such a short period of time seem incredibly fortunate to this trader.
There's as much skepticism on Wall Street as there is on the farm about how Mrs. Clinton managed to make such a killing. Maury Markovitz has spent his career trading futures. His clients have given him $40 million to invest for them.
My best year in trading, I multiplied my money by 22 times. That was very unusual. But I was able to do it.
That was your best, 22.
That was my best year.
And Mrs. Clinton?
She did 5 times better than I did. She multiplied her money by 99 times. She did it in 10 months. It took me a year. I had 16 years experience.
After these trades, there were some investigations. The former chairman of the Mercantile Exchange was brought into the White House, where he said that although it seemed that much of Clinton's gains came from the trades placed by her broker, it, quote, doesn't suggest that there was an allocation of trading profits, but it doesn't prove that there wasn't. Allegations still floated around that Hillary was given preferential treatment by her broker as payment for political favors regarding legislation that would affect Tyson Foods, which her broker was connected to. In response to these allegations, Hillary's defenders said that she had made both winning and losing trades during her stint as a futures trader, and that Tyson's CEO had in fact endorsed Bill Clinton's opponent in 1980. However, the New York Times noted that the Tyson CEO only endorsed Clinton's opponent 2 years after the massive trading profits, and after Bill Clinton failed to lobby in favor of Tyson's interests. There was never any official investigation by any branch of the government into the background of Hillary's cattle futures trading profits. Alright guys, that wraps it up for this video. If you liked the content, make sure you hit that like button and subscribe for future content. In the meantime, make sure you're following us on Instagram and TikTok, and we'll see you in the next video. As always, thank you so much for watching. Wall Street Millennial, signing out.